All right, everybody, this is Ted Bauman here. We had some technical difficulties getting started, probably related to the fact that my camera was in use by another application. But I'm here now, and apologies for the social media folks here at Banyan who've been trying to help me get online. So, as you know, the goal of these exercises is for you to submit questions to me. And the idea is basically that I will answer questions that you send in and try to you know try to see what we can make sense of the scenario here. Now, or sorry, basically the idea is that, or at least my thesis is that a lot of people have been looking at the Federal Reserve and looking at their um, their uh, plans to tighten, plans to basically increase interest rates, run off their balance sheet, etc., and thinking that it's in relation to inflation primarily. I don't think that's the case. I think it's tangentially related to inflation, but I suspect that the Fed is actually using the excuse of inflation to do something that it's been wanting to do ever since roughly around 2013, and that is basically to withdraw from capital markets. I'm encouraging you to send me through questions on that topic, and I'm presuming everybody out there can hear me. But that's basically the topic for today. So if you have any issues you want to raise, you have any questions that you want to send to me, please send them to me into into the chat screen. I see Chicken Charlie is there. Go ahead and send me a question if you got them. I know that one question has already come in a little bit early. Chicken Charlie says, isn't the Fed limited as to how much they can raise rates because of the debt? Well, I guess they are, aren't they? But at this point, we're looking at the potential for a 750 basis point increase in interest rates, or rather in the interbank lending rate, over the next, 4 quarters. By anybody's measure, that is still an extraordinarily low interest rate. It doesn't even compensate for for inflation. So, basically at this point, you're still looking at free money. So in theory, yes, there will be an impact on federal borrowing costs. But remember that one of the things that the Fed can continue to do is to continue to roll over interest payments into new bond issuance. And basically, that's what it's been doing for quite a long time. Essentially the idea that there's a hard constraint that doesn't really apply to the United States, given the way that the monetary system works. Another question comes in from Pulverizer A. That's a great name you got there, buddy. Even if the Fed jacks rates, can they jack them enough to find a return outside markets? Well, you're talking about fixed income markets, right? I mean, basically, you know, the direct relationship is between, bonds and stocks. And my answer would be no. I mean, right now, given the inflation rate and given the the likelihood of the nature of the rate increases that we're going to see, no, I don't think you're going to get a return. I think the only people who are going to get return on bonds in the short term are people who trade derivatives on them, who short them, and so on. But for the foreseeable future, I don't see bonds as being an actual mechanism of return or yield of any kind. In fact, it's hard to see how that could happen, for quite a long time. Again, because we're raising interest rates from such a low base. So basically, for me, the big question is, um, if the Fed is raising interest rates, is that the key issue? Or is it the Fed desiring to withdraw from the capital markets altogether? Uh, Alex Rosa said if the Fed wants to tighten, then SQQQ, FNGD, and SOC seem feasible until the Fed realizes it can't tighten. So you're talking about inverse, basically inverse ETFs. Sure, I mean you could try playing inverse ETFs to see what happens if you're playing, I guess, SQQQ right now. you probably could make a little bit of short-term gain. But I think the critical thing is that it's not really about the interest rates. It's more about the Fed's balance sheet, and whether the Fed is going to actually speed up its basically getting rid of these, the bonds that it's got on its balance sheet, because that's really the nature of quantitative easing, right? I mean, interest rates is part of it, but in a way, the most important thing of all is the rolling off the balance sheet. Just to let's take a step back and just make sure we're all on the same page about what this means, how this works. Quantitative easing is basically it's an extraordinary monetary policy mechanism whereby central banks buy financial instruments, in the United States case, treasury bills and mortgage-backed securities, from banks in return for excess reserves that the banks get. Now, the banks can use those excess reserves to create cash deposits in their own systems. In other words, if they wanted to lend more money because it's a fractional reserve system, having more reserves at the bank, at the Fed, means that they can issue those loans. The problem with quantitative easing has always been that that's not how loans get made. People don't make loans just because they have money to lend. They make loans because they think that there's a prospect that they'll get repaid, and that they'll get repaid at a profit. The big problem that we've had, particularly going back to the great financial crisis, I've actually got a chart here that I wish I could show it to you. We're working on being able to do that hopefully next time. But I'm looking at a chart that shows the S&P 500 versus the inflation rate going back to about 2012. And what's interesting to me, and this is really the foundation of my whole argument here, is that while we've had quantitative easing, where the Fed has been buying these treasury bills and buying mortgage-backed securities out of the market, ever since 2009, 2008, 2009, the inflation rate didn't go anywhere, nowhere. It did not increase at all until we started pumping stimulus into the economy, and until we started getting supply chain problems. So if that's the case, if the inflation, I mean, if you look at the historical record, QE did not cause inflation. So why should withdrawing QE reduce inflation? In a sense, that's part of what I want to argue today. Because I would say it won't, because inflation is not caused by quantitative easing, at least not in consumer and real goods markets. It causes inflation in asset markets, right? It causes inflation in the stock market. That's why we've seen the increase in stock prices that we've seen. They are much higher than they would have been if in the absence of QE. So here's the problem. If the Fed is raising interest rates to combat inflation, but it didn't cause that inflation, and because history shows that QE didn't lead to inflation in the real economy, then what can we expect? Why is the Fed doing it? I think the Fed's doing it because it wants to wean the stock market off of QE. It wants to go back to what it calls a quote unquote normal relationship between the Fed and capital markets. Now, let me see if we've got some. Thanks, Mark. He says a great train shirt. Yeah, he's my favorite jazz musician ever. Now, Rosalind T is saying, what would you say that this will have a minimal impact on mortgage rates, mostly for folks with ARMs, and small impact on housing? That's a good question. I did actually pull some charts on housing. Again, I wish I could show them to you, but basically I'm looking at a chart that shows an absolute tracking relationship between the the Fed's balance sheet and the Case-Shiller housing index. It's pretty remarkable. The track is, there's a little bit of a delay, but there's no question. So your question or your observation, Rosalind, is that it shouldn't have too much of an impact. Well, interest rates are at their highest point since May last year. Right now, they're over 3%, the average 30-year. I'm sure if you're on an ARM, you're looking at potentially some trouble. But again, historically speaking, we're not looking to go back to the late 90s, when we had that enormous jump in variable interest rates on mortgages. It's going to be more expensive to borrow, but that should lead to a decline in housing prices, because the two have an inverse relationship. The higher the rate of interest you're paying on a mortgage, the less you can afford to buy in terms of house. Once that works its way through the market, housing prices have to come down. So part of the reason why housing prices are so high right now is because interest rates are so low. So hopefully the impact will net out, that you'll get higher interest rates but lower house prices. I mean, right now, I think, in fact, I noted this I made a bunch of little notes that here. The median new home price in the United States, a new home price in November last year, it was $417,000. That's the median. Okay. Now, the vast majority of people in this country cannot afford anywhere near $417,000 for a house. So if that's the median, that'll just tell you where we are. Now, the figure for existing homes, which includes everything from, Malibu mansions down to, shotgun shacks, down by the railway line here in Atlanta, is $353,900. So basically, by anybody's measure, house prices are way out of line. So there is a definite impact. But again, I just want to steer us back to the question. I think that's why the Fed is doing this. I don't think the Fed is worried about inflation in the consumer economy. It has a political problem with inflation. Yes, I mean, that's a political issue. It has to show resolve. It has to show, that it's not going to, allow this to continue. But at the end of the day, I think Powell and the rest of the governors know that they didn't cause this inflation and they can't make it go away, but they have to be seen to try. And that gives them an excuse to start to pull back on their support for the stock market. All right, so a couple others here. Oceanfront Net Corporation says, Ted, how do you suppose the Fed can withdraw from cap markets when they printed 50%, more than 50% of the debt the last 4 years? And do you really feel that the Fed will never be able to withdraw? I presume you mean 50% of the federal debt? Well, yes. I mean, monetizing federal debt is a big part of this. And in a kind of a backdoor way, yes, the Fed is responsible for inflation in the sense that when the Treasury issues stimulus checks or anything else, or cancels, debt of any kind, or does anything that involves actually dispersing money or not taking money in from the economy, and the Fed sells Treasury bonds that enable them to do that, then yeah, that's kind of backdoor money printing in the real economy sense. But I would argue that that's actually the one of the major causes of inflation in the last 12 months has been the fact that people have cash thanks to stimulus. They have cash, maybe as a result of not spending as much on services, and they've switched all their expenditures to goods. And of course, goods have a finite supply, so does labor and all that kind of stuff. Again, that's not really a result of quantitative easing. What is a result of quantitative easing is the phenomenon of people being willing to plunk, huge amounts of capital on companies that have no prospect of positive earnings or positive profits for 3, 4, 5, 6, maybe even 10 years down the road. That's the impact of quantitative easing, and I think that's probably the dominant thing that the Fed is trying to address. But again, that's not what the financial press is talking about, right? I mean, the financial press is talking about inflation, saying it's the Fed's fault. It's mythology. That's my argument. I mean, I'm saying that the Fed is simply not responsible for the inflation that we're seeing, and so therefore it can't hope to affect it. Maybe on the margins, it sends a signal, right? And it sends a signal to business, and it sends a signal to others that financial conditions are going to be tight. But the critical issue is that if the main impact of QE has been on asset markets, the stock market, housing markets, and also more speculative markets like crypto and NFTs and all that, then that's where you can expect to see the pain, right? So the big issue right now, I think, is if that's the case, where's the market going to go from here? And Clint Lee and I, my partner in crime, we've been talking about this really for the last 3 months or so, and we're already seeing a big rotation away from those kind of growth stocks and into stocks that are undervalued. Having said that, there are some growth stocks with good prospects that the better growth stocks, the cream of the crop growth stocks, not your SPACs, but the ones that are really onto something. Those are reaching heavily oversold territory, and we're beginning to see some value hunters pull into them. So don't write them off yet. But I think there's a big question mark over the top of the food chain when it comes to tech. In other words, the so-called FANGs, or whatever the latest acronym is. But let me get back to some of your questions. Cody Sheffield says, talk about bonds a little more. I'm in the mortgage business. I'm curious how the next 4 quarters will affect mortgage rates because of the bond market. Well, I mean, you know how it works, Cody, because you're in that business. You know that essentially bond rates or mortgage rates are extremely sensitive to the treasury market. I mean, if you look at how, like, for example, mortgage REITs and other aggregators, the secondary market for mortgages works. All of their pricing is based on federal funds rates and bond rates. So to the extent that the Fed hikes maybe 3 or 4 times this year, yeah, it's definitely going to go up. I wouldn't be surprised to see us hit 4% annual by the end of the year. But if we do, I mean, that's still historically low. It's dramatically low compared to longer term mortgage rates. So, but again, one of the critical things is that if you're a buyer of a house, what you're really aiming at is your payment, right? It's the payment that matters, and the payment is a function of your interest rate and the price of the property. Interest rates go up, property prices have to go down to keep that payment stable, and they will go down. Now, of course, there are some limits. I mean, if I saw this morning that the lumber price is headed back up again, which is because of problems in western forests in the United States and Canada, where they're having problem with pine bark beetles and climate change and all that. So there is a floor. I mean, obviously, you can't expect new house prices to fall indefinitely, but we could see a pretty significant drop in the value of existing homes, which of course could have an impact on people's sense of wealth, their net worth, and that could affect their spending. So that could have an impact too. But generally, I don't see super high mortgage rates coming soon because I think the Fed, it's really more about signaling than anything else. And I want to come back to this question of balance sheet runoff. Um, all right, so Paul Serwinick says, um, is it true we can expect bonds to go down in value over the next year? Where should we invest in bonds in view of that? Well, yeah, I mean, if yields go up, the price of bonds go down. It's hard to see how anybody can make money investing in treasury bonds right now, simply because other than the TIPS bonds, the inflation adjusted bonds, by definition, you're going to lose money because right now the inflation rate is above the yield of any of them. I'm not sure what the current yield is. I don't have my spreadsheet open, but basically, although those yields are rising, they're still well below what you need to be compensated for inflation. So at this point, I don't see how bond markets really serve a purpose for the average investor. For institutional investors, obviously, they serve a critical role as collateral, and therefore, they'll have big impacts there, but not for you and I. Um, Follow up from Oceanfront Nell. How can they withdraw at all with such a fake economy with pay later and now drained stimulus checks? Well, again, I mean, this goes back to, I think, a fundamental confusion that a lot of people have about the Fed's role. The Fed does not directly contribute money to the real economy. Okay. The Fed does not print money. Okay. There's no money printing. People talk, I see intelligent people write that phrase, printing money in respectable financial news outlets. They're just, as we say in South Africa, they're talking twak, which is basically nonsense. And fundamentally, I think the problem is that people think that somehow when the Fed creates new money in order to buy treasury bonds and mortgage-backed securities from the banking system, that money somehow automatically gets out into the real world and goes into people's pockets. That doesn't happen. What happens is it increases the bank's ability to create new loans if they want to, if they see that there are opportunities to lend profitably to people. But if they don't see those profitable opportunities to lend money to people, whether they're corporations or individuals or whoever they are, they're not going to make the loans no matter how cheap the money is, right? There's a demand and a supply issue when it comes to credit. Also, the ordinary person is not going to borrow money from a bank if they don't have an opportunity, let's say, to start a business, if they don't see an opportunity for profit. So again, there's a demand and a supply issue with loans, and the Fed providing cheap money to the financial system does not automatically translate into economic growth. What does, as you pointed out, just to go back, who was it? I think it was Oceanfront Nell saying, what about all the stimulus money that's coming out? Well, yeah, it is coming out. And that money did ultimately originate in the Fed being prepared to issue new treasury bonds to replenish the Treasury's account so they could issue stimulus checks. So yeah, in that sense, the Fed has done that, but that's not the main part of their activity. If you compare the amount of money that's gone out in fiscal stimulus compared to the something like $7 trillion worth of assets on the Fed's balance sheet, there's really no comparison. But yes, and I think that's part of the issue right now. If stimulus is disappearing and people are going to run down their bank accounts, and this whole inflationary impulse begins to fade because there isn't that extra money in the economy, then yes, then I think the question then becomes, what happens to the Fed's tightening? What does that do? Somebody over here, in fact, asked that question much earlier. They mentioned somebody, Paul Bullard, who's yeah, L. Weiner, in said earlier, he there's a headline I'm thinking, you said Fed's Bullard says easing inflation could diminish need for aggressive tightening. That's true. That's a distinct possibility. But again, I don't think that's the reason why the Fed is talking about hiking so quickly. I mean, if you look at the number of interest rate hikes that the market is pricing in, and how quickly they expect them to start. They expect them to start with the FOMC meeting in March, and then to be at least three, maybe even four more during the course of this year. I don't think that's about addressing inflation. That's about trying to rein in the stock market. It's about trying to rein in the amount of money that's going into speculative assets like crypto, things like that. Why would they want to do that? Because they know that that has become a destabilizing factor in the economy. If people have spent a great deal more money speculating on stock prices than they have investing in the real economy, even big companies. I mean, companies that do buybacks, that issue dividends. That's not about creating new wealth, creating new jobs. That's about financial engineering. And the problem is that QE, in the way that it's currently structured, encourages that, and the Fed realizes that that's not a sustainable future, and they want to rein this back. But the big problem is, um, if you do that, what happens to the stock market? Because the stock market does have a big impact on the real economy, right? Because if the value of people's stock holdings fall, they feel less wealthy. They start to pinch pennies. They don't spend, and that leads to a contraction in the real economy. But on the other hand, if you let things get out of hand the way they have, you end up with ridiculous situations of price to earnings ratios, that are sky high, price to sales ratios. I mean, basically anything over 10 would be considered idiotic as a price to sales ratio. And yet there are dozens, hundreds of companies in the stock market with those kinds of valuations right now. I think that's what the Fed is doing, but they don't want to say that out loud because it's a wink, wink, nudge, nudge relationship that they have with the stock market there. All right. Here's a note. Clint says there's a question from Ted Masiak who says, I guess I'm pronouncing that right. Ted, another Ted. Is it still a good idea to move funds from IRAs to Roth, paying the taxes now versus later? That is kind of off topic, but it does raise questions about the timing of your financial activities in a context of high inflation, and potential for tax hikes. I'm sort of agnostic on that. I think in general, it's always a good idea to to be overweight Roth, simply because they give you the opportunity to compound things like dividend payers, sort of perpetually until you need to start withdrawing, and then of course when you withdraw, you're taking them at no tax. My guess is that taxes will go up in the future one way or another, and partially that reason would be because precisely the interest servicing component of the federal budget will have to rise to meet all these debts and higher interest rates. But whether to do it right now, or to wait a couple of years, it's difficult to say. But generally speaking, I think if you think taxes are going to be higher in the future, then yeah, you want to do it now. My guess would be that would be the case. Kind of doubt that the Democrats are going to be able to push through a tax increase this year. Just doesn't seem like it's going to happen. Of course, if the Republicans regain the House and Senate in November, then that definitely won't happen. But basically, uh, in the long term, I think you could bet on that. Here we are. Harlan Bauer says, is the Congress spending such huge amounts, or potential spending huge amounts, hurting the Fed's ability to do its job? Well, it depends on what you mean by the Fed's job, right? I mean, the Fed's mandate is stable price levels, which is generally consistent with about 2% inflation over time, and full employment. And of course, full employment involves some frictional unemployment, which is not a big deal. Right now, I think the Fed feels like 3.5%, 4% is probably normal frictional unemployment. That's the Fed's job. The Congress spending money. In fact, the Fed, if you look back over the last 10 years, one of the most consistent messages that the Fed has put out is the desperation to get Congress to spend more money, because that means that it takes the attention off the Fed. The Fed doesn't have to use this, push on the string of QE to try to get the economy moving. Remember, it's not QE that made the economy recover from COVID, right? I mean, it wasn't the Fed pumping money into the markets that has given us, quarter after quarter of growth ever since the big dip. What it is it basically started with a low base point in that second quarter of 2020. There's a natural tendency, for any kind of recovery is going to be faster than from that base point. But on top of that, it's just people realizing that life doesn't have to stop completely with COVID. I mean, the notion that we were going to eradicate it by, completely shutting everything down, the Chinese are still trying, but it's not going to happen. So what's been happening, I think, is that the economy has been growing quickly because because we're starting from that low base point, but B, because there has been a lot of stimulus money and a lot of people have shifted from spending on services, going out and doing things where they're potentially exposed to COVID, to buying stuff. And when you switch a lot of money, when you have a lot of money in the economy and people are switching to buying stuff, then you run up into supply constraints, and those two together cause inflation. So in a sense, all that has to do partly with federal spending, which again, the Fed had been asking for years and years, but they were asking for it before COVID. Remember that the average rate of growth of the U.S. economy, and again, I'm going to refer to a chart that I wish I could show you, but I can't. If I'm looking at the CPI, or rather a GDP growth, where's my chart? Going back many years, really, here it is. Prior to about, I guess you could say 1990, the average rate of growth of domestic product, in other words, the average annual year-on-year change on a quarterly basis, was somewhere in the neighborhood of around 4.5 to 5.5% up to around 1990. This is going back to 1950. It slowed down a bit during certain periods, but ever since 1990, the average rate of growth of GDP in the United States has been around kind of 2, maybe 2.25%, right? So we've seen a 50% decline in GDP growth from a previous period to now. And that was certainly the case after the great financial crisis, despite the fact that the Fed was, QE, all the stuff that we're talking about. And for me, that confirms what I'm saying, is that QE doesn't drive economic growth. It doesn't drive investment. It doesn't drive lending. It doesn't drive, new decisions to spend, all that kind of stuff. It drives asset markets. Now, lately, we've seen a much more rapid growth in GDP because, as I explained, the federal government has pumped stimulus money into the economy. And as a lot of people have predicted for years and years, when you do that, then you get rapid GDP growth. Okay. So to the extent that the Fed has been asking the federal government to do that for the last 10 years, that's because they know that. They know that if you want economic growth to speed up, and if you want more people to get jobs and wages to increase, you need more money in the economy. And or you need to redistribute the money so that it's that more people who have a higher marginal propensity to spend money have money. In other words, the less money you have, the more likely you are to spend it on something as opposed to put it into savings, all that kind of stuff. The bottom line is that we're in a situation right now where the Fed is finally, kind of getting what it's wanted, right? It's always wanted the federal government to increase its fiscal stimulus so that they could withdraw theirs. And again, that's my thesis today, that the inflation thing is, in a sense, it's a good excuse, and it's a valid excuse, but what they really want to do is get out of the QE game, and they want to do it quickly. And the real fireworks are going to start in the fourth quarter of next year, when they start selling or failing to roll over treasury bonds and mortgage-backed securities that they hold already. Because right now, all they're doing is slowing down their purchases. Once they've stopped accumulating, then they can start selling. What happens when you do that? Well, suddenly there's an increase in supply of treasury bonds. What happens when there's an increase in supply of something compared to stable demand? Their price drops. That means yields rise. So in a sense, it's not just about the Fed's interest rate decisions. It's about this critical thing of them rolling off $7 trillion, folks, $7 trillion worth of stuff that they have accumulated. And of course, the same thing applies to Europe. The Japanese conceivably could do this, although they've been playing this game for a lot longer. But at the end of the day, I think that, the real question is whether or not uh, the current structure of the economy and the stock market can handle it, or whether we have to have a big crisis or crash. Let's see here. We're getting an argument over here, which is interesting, um, about the relationship between the Fed and income inequality. I'd like to talk about that. It's a little bit off topic, but Pulverizer A says the poorest in the USA are rich in comparison to the rest of the world. I don't know, Pulverizer. There are some people out there who are living in worse conditions than I've seen in a lot of parts of the world. But at the end of the day, I think the critical issue is that whether or not whatever the nature of poverty, the fact is that people who have very little money have a much higher propensity to spend than people who have a lot of it. In other words, their impact on inflation, their impact on demand and production is a lot more pronounced and more immediate than if money is being kind of concentrated at the top of the income pile. So fundamentally, I think there this is an important side argument, but it's not central today. But it's true that the Fed is worried about that. I mean, we know, right, that the Fed has said over and over again that they are concerned with the frothiness of asset markets, and it's not just because you have high housing prices, you get stock prices going through the stratosphere, you get people with excess money pumping it into speculative assets that don't provide any yields, like crypto, that kind of thing. But the other issue is that it also deepens inequality, which in turn creates instability, which tends to create more economic crises, which tends to basically create a flywheel, kind of a negative flywheel. So in that respect, I think the Fed is also concerned about that. Let's see here. A very interesting question. Somebody raised one of my favorite concepts. G. Wills says, we're playing a rigged game as long as the Fed is in charge. Cantillon effects eat labor's marginal gains while generating escape velocity profits for asset and equity holders. That is a really interesting point. What's the Cantillon effect? Back in, I think, the 18th century, or maybe even the 16th century, I can't remember which, there was a French economist who observed that whenever there was an influx of gold into the monarchy, in other words, when the French monarchy received a bunch of gold from whatever source, whether it was wars or colonies or something like that, that Cantillon noticed that the immediate effect on prices tended to be people who were closest to the royal household. Why? Because they were the ones who were most likely to end up getting a portion of that. And the application of that to the Federal Reserve is that it's the institutions that are closest to the Federal Reserve that end up being able to use the money that the Fed is creating, i.e. that gold in the royal house, to buy things, which in this case has been stocks and assets. And increasingly also houses, as an aside, because I also pulled a chart that showed that the proportion of homes that were being bought by investors as opposed to ordinary people is now at the highest rate that it has been basically ever. It's now getting towards about it's almost 19% of housing purchases in the last quarter went to institutional buyers. So that's an example of the Cantillon effect. Institutional investors are the ones who can access the money that is being created by QE. They're using that money to buy things like houses, and eventually that's going to cause the price of housing to rise, and so that in turn will mean that the people who buy those houses will have to start demanding higher wages, and that'll lead to inflation across the board. which was precisely what Monsieur Cantillon argued about France back in those days. So, very good point. Glad to see some economic history in there. Here we are. Taylor says, would you invest in Bitcoin if you were under 35? And what's your view on the Bitcoin market? If I were under 35, I probably would, because I wouldn't know what I know now. I guess that's one way of putting it. No, look, I mean, look, my take on Bitcoin is that it is a speculative asset. It's it's basically gambling as far as I'm concerned. I know that the true believers out there are going to hate me and start sending things into into my list. But the bottom line is that I would buy it and then I'd probably end up selling it. And I would probably go through that whole sort of cycle where I bought it when it's rising because it's rising, and then I'd sell it when it's falling because it's falling, and I'd keep doing that until I ran out of money. Um, I have a feeling that that's going to happen to a lot of people. I don't know what the top level is for Bitcoin. Goldman Sachs came out with an analysis recently saying they actually had a chart that purported to show the proportion of money invested in, basically store of value. It had gold, and then on top of that, it had Bitcoin, and it showed that given the increasing role of Bitcoin in the the store of value market, that potentially you could end up with Bitcoin hitting $100,000 just because people are doing that. So OU812 says, so Bitcoin is not an inflation hedge. I already saw it, Clint. Thanks. No. How could it be an inflation hedge? It doesn't have a stable value. Gold is an inflation hedge. Because although its value fluctuates, it tends to be in a predictable relationship to prices, right? So when you get when prices rise in dollar terms, the gold price goes up too because gold's priced in dollars. And that's fairly straightforward. Bitcoin's pricing is not like that, is it? I mean, it's not. You can't say as a given that the price of Bitcoin will rise when prices rise. In fact, if I'm not mistaken, Clint, maybe you can look this up for me while I'm talking. Bitcoin has been on a slide in the last quarter, right? While prices have gone up. So how could that be an inflation hedge? Again, I know a lot of true believers or true believers will say that it is, but empirically it hasn't been. It shows no relation, between inflation and value. Chicken Charlie says, so how can we profit from the Fed increasing rates? Which is a great question to end. I've been on for 45 minutes talking nonstop. So how can we profit? Well, I think the first thing is to recognize where that's likely to go. Where stock prices and asset prices are likely to go as a result of rising rates, and in particular as a result of the roll-off of the Fed's balance sheet, which will really have a big impact on bond markets, I think, starting from the fourth quarter next year. First of all, is to recognize that there's going to be a shift of money away from what we call duration trades, which are trades where the long, money is going to come in the future, and because of low interest rates, the present value of that future money is high. As that reverts, as it changes, as the future value or the present value of that future money falls, money is going to shift into value, and we've already seen a big switch in value. In fact, I looked at a couple of ETFs this morning. One of them was a VOOV, that's Fidelity's value ETF, versus a VOOG, which is Fidelity's growth ETF. And you just basically do a ratio between them, and value has just skyrocketed since the beginning of the year. So I think the critical thing is, first of all, if you want to make money out of this, you want to start looking for value plays. In other words, you want to look for stocks that people have been ignoring because they're not sexy, they're not memes, and try to figure out which ones are undervalued relative to their future earnings. In fact, here at the Bauman Letter franchise, we've been doing an exercise where we look at FY 22 and 23 earnings of potential companies, and we look at their current share price versus the fiscal year 23 potential earnings, and we say, what's the price to sales ratio for 2023? And if it's really low, that's a potential acquisition, because when people run out of opportunities to speculate on growth stocks, they're going to look for yield somewhere else, and that's where they're going to find it. So that's the first thing I would do, is start, having another look at value. The other thing is basically to look at the possibility of companies that actually thrive in inflationary positions. Companies that have, for example, pricing power, companies that can raise prices along with rising inflation, rising labor input costs, even rising interest rate costs, which is a big factor with rising interest rates. If they can raise their prices along with that, they're going to be better investments than companies that are going to see their margins squeezed, particularly if they have a lot of debt. So that's another place to look. Conversely, you want to stay away from companies that have high leverage, particularly if they're in the junk bond area where they could end up being squeezed financially because of rising interest rates. I don't know what's been happening with high yields, Clint, in the last couple of months or so, but my sense is that you're starting to see an uptick in the high yield market. And that's going to mean a lot of these companies are going to start running into cash flow problems, and that's going to affect their growth. So again, stay away from those. So again, it comes fundamentally back to fundamentals. Okay, last question from Dan Heron says, great show, Ted. How do you think supply chains will shift over the next 5 to 10 years? Will it be possible to restore or strengthen the NAFTA bloc? I don't know. That's anybody's guess. I mean, I think right now supply chains have suffered their first real shock in the fully globalized era, particularly with the relationship between China and the U.S. Not just politically a relationship, but just in terms of the ability to transact given COVID. So yes, I think there will be some reshoring back to the North American bloc. Same thing will happen in Europe. Whether that is going to be a permanent fixture or whether it's going to be focused on just specific parts of the supply chain, who knows? Because remember, the supply chain these days is not just about physical goods. I mean, a lot of the software that is, software as a service companies that are making a lot of money these days are a lot of their software development happens in places like India and other parts of the world. And so supply chains are not just about physical goods and services. But I think when it comes to things like, particularly like in the automotive sector, particularly high-end tech manufacturing, I do think we're going to see a reshoring back into the NAFTA bloc. But we might also see strengthened ties between Europe and the United States around technology as they coalesce vis-a-vis China to try to reduce dependency on China. Because clearly, if what we hear about what the Chinese have done, with technology, there was a news report I read recently about how the Chinese had somehow put a bug into a critical piece of infrastructure in the Australian telecommunications networks, and they had basically used that to copy everything that was passed through one of the cell networks in Australia a couple of years back. They copied everything that happened for a couple of days. That's the kind of stuff that's going to lead the U.S. and Europe to come closer, and so that is one potential thing. Anyway, I've been talking nonstop for almost 50 minutes, which is even my wife and child will tell you that's longer than my normal. So I'm going to sign off now, but thank you very much for joining. If you find these useful, let me know in the comments. Remember, the Bauman Letter is free for you to subscribe to with a money back guarantee. We are basically doubling down on our income plays. One thing I didn't mention is how much I like companies that are paying and increasing their dividends in the next year or so. I think that's going to become an increasing part of overall market returns. Is going to come from dividends. So that's where we're going. And I'll talk to you again next quarter. How's that? Bye-bye. Thanks very much.